Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing cryptocurrency market volatility part 1. The cryptocurrency market as a whole is known for being volatile from its very conception. The past couple of years have undoubtedly been a rough ride for millions of investors, but things are starting to look better. While some people managed to make their fortune investing in cryptocurrencies, many had lost large sums in the bubble that burst in the beginning of 2018, which is when the bear market started. However, Bitcoin as well as other cryptocurrencies are not made to be volatile, but for the reason of fulfilling their purpose. Certain cryptocurrencies were created to provide specific utility to its users, while others are designed to be digital money and to compete for fiat currencies directly. To understand why cryptocurrencies are volatile, first we have to understand the factors surrounding the industry. What is volatility? Traditional finance defines volatility as the fluctuation of an asset's price in a particular time period. An asset is volatile if its price is rising or falling constantly and aggressively. The cryptocurrency market is a definition of the real volatile market, as the extreme fluctuations add and remove billions of dollars worth of market capitalization to and from the market every single day. Adoption and market maturity versus volatility. Bitcoin in the cryptocurrency market in general is a relatively new concept when compared to other well-established traditional asset classes. A cryptocurrency must have a large user base to fulfill its role. The larger the user base of an asset, the less volatile and safer it will be. People have to learn how cryptocurrencies work and how using them will change the world. Only after fully grasping the concept of cryptocurrencies they become less volatile. As more people start using cryptocurrencies, prices will even out and volatility will decrease to the point where fluctuations will be so small that they will no longer matter. One thing to note is that the average cryptocurrency investor is not a financial expert by any means. This makes concepts such as FOMO and FUD an even more significant factor than they already are in traditional markets. Speaking about adoption brings us to the maturity of the cryptocurrency market. A young market backed by a brand new technology will, by nature, be more volatile than the already well-established traditional markets. Cryptocurrencies are going through an infancy period that is very similar to the one that the internet-based companies had to go through in the 1990s. New technologies require time to get perfected. They also have a high probability of failing. Bad press versus volatility. News reports, whether positive or negative, can easily affect the cryptocurrency volatility. With an average investor being relatively uneducated of how the markets work, each wrong portrayal of cryptocurrencies can spark a new wave of FUD. News reports, such as the ones about hacking incidents, certain countries declaring stances on crypto, as well as people with questionable pasts being tied to the industry, instill a negative reputation of cryptocurrency markets in the minds of people. At the moment, cryptocurrencies are incredibly vulnerable to all those bad press and news, and they rarely react to the good news. New portals are often catering to the short attention spans of their millennial readers by writing outrageous and often fake biased texts. Fraudulent activity versus volatility. Cryptocurrencies have been in a place where fraudulent activities occur more often than with other markets, without any doubt. The crypto market has mostly seen two types of such activities. #1, Ponzi schemes, and #2, hacks and security breaches. Ponzi schemes are a not-so-rare occurrence in markets governed by greed, and the crypto market is no different. Whenever people that lack knowledge of the markets try to get rich quickly, Ponzi schemes appear. Ponzi schemes are a form of fraud where the company promises quick and substantial returns to the first investors by paying them money from investors that come to the project later. The most famous Ponzi scheme in the crypto market is the notorious BitConnect. The HYIP program promised high returns to all of their investors. They used their native BCC token to pay out their old investors. Seeing high-yield great payouts automatically attracted the new investors. BitConnect was undoubtedly not the only Ponzi scheme organized in the market. Many have successfully attempted to defraud people of their cryptocurrency holdings by creating a high-yield investment program. Crypto market security breaches. Markets gain in volatility when an aggressive event strikes the space, and cryptocurrencies are no different. There have been several occasions where security breaches, as well as hacks, cause extreme volatility spikes. None of these hacks happen to the cryptocurrency specifically, but rather to the exchanges that stored them. One good example of increased volatility is the infamous MTGOX hack. This hack caused the biggest cryptocurrency exchange at that time to close their doors, making 850,000 Bitcoin vanish. Later on, 200,000 Bitcoin were somehow found and retrieved, and are now handled by a trustee who sells them as he pleases. This trustee was one of the main reasons for the increased volatility, as he reportedly sold the Bitcoin on the open market rather than over the counter, as should be done with such quantities of cryptocurrencies. If you enjoyed the video, please like and subscribe, and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.